that would give us cost of goods available for sale. Then we would subtract ending merchandise inventory, and that would give us cost of goods sold. There's a table here with data, and then I'll split my screen again. So beginning inventory, it says 17 units at $15 each, so that's $255. And then for the purchases, there are two purchases. So the first one is 5 units at $19, and the second one is 11 units at $23. So in total, the purchases would be $348. And then to add together the beginning inventory and the purchases to get cost of goods available for sale, that would be 603. So these first three lines that we filled out, those are going to be identical regardless of which of the three costing methods we're using. Okay, then for ending inventory, we have to figure out how many units that would be. So going back to our information table, we started out with 17 units. We purchased 5 units. We sold 14 units. We purchased 11 units. And we sold 13 units. So, what did I do wrong here? Oh, I did something wrong. Okay. We purchased 5, sold 14, purchased 11, sold 13. Okay, so we ended up with 6 units. So first in, first out. Are these units in ending inventory the old ones or the newest ones?
Old.
First in, first out means we sold the old ones. So they would be new ones. So the newest ones are these ones that we purchased on June 24th. And we purchased 11 of them, so all 6 of them could be some of those. So 6 times the $23 that we paid for those that we purchased most recently. So that would be $138. And I'll enter it with a minus sign just to show that we're subtracting here. And then to do the subtraction, we end up with $465 as our cost of goods sold. Okay, then doing LIFO, as I said, the first 3 lines would be identical to what we had for FIFO, 255, 348, 603. And then we know that we still have 6 units in ending inventory. now the 6 units are gonna be some of the oldest ones. So, the old ones we paid $15 each for. So 6 times $15 would be $90. So here we'll put minus 90. And then by subtracting, we end up with $513 as our cost of goods sold. Okay, and then doing this for weighted average, again, the first 3 lines are going to be identical. Okay, now we have to actually compute our weighted average. So, we know the cost of goods available for sale is $603. Now the units available for sale, we would be taking the 17 that we had in beginning inventory plus the 5 that we purchased plus the 11 that we purchased. So that's 33 units that we have available for sale. So now take 603, the dollars available for sale, divided by 33, the units available for sale, and we come up with about $18.27. So take that weighted average cost times the 6 units that we have in ending inventory, and so that would be about $110. So we'll subtract here $110. And so what we're left with for our cost of goods sold would be $493. Now we're supposed to calculate the gross profit for each method. And sometimes with these problems, students get stuck on this because they don't see where the sales revenue comes from. So to figure out the sales revenue, it's going to be the same regardless of which inventory costing method we're using, but you would have to go up to the data table, and we have 2 different sales, but fortunately each sale is for the same unit price, $37. So the first sale was 14 units, the other sale was 13 units. So if we just take 27 units times $37 each, our total sales revenue is $999. And then our cost of goods sold, from the FIFO calculation up above, we said it was 465. We'll enter that here as a negative number. So then subtracting our cost of goods, our gross profit is $534. And doing this for LIFO, same sales revenue, $999. Up above, we said our cost of goods sold was $513, which we'll enter as a negative number. So our gross profit is $486. And then for weighted average, 999. Up above, we said our cost of goods sold was 493, which we'll enter as a negative number. And so our gross profit is 506. Okay, now we'll go to a problem where we do the three methods using a perpetual inventory system. And again, we have a data table that we open up. And the first part of the problem will be doing FIFO for the costing method. This is a little bit different format because now the beginning inventory is not in the data table. So instead we have to read the problem and see where else it is that they give us the beginning inventory. But you can see right at the top of the problem, they say that they began the month with 55 units. And so we'll fill that in, 55 units at a cost of $35 each. And then we have to multiply that. So that would be $1,925. Okay, then on the 3rd of January, the data table says that they had a sale, and so they sold 45 units. This would have to come out of the beginning inventory at this point, so cost of $35 each. Total cost multiplying would be $1,575. And then that would leave us in inventory with 10 units at $35 each, total cost of $350. Then on the 8th, we had a purchase, so 75 units at a cost of $52 each. So that would be total cost of $3,900. And so then inventory on hand, we would show 2 layers of inventory. So the first layer we would copy down from above, so that would be 10 units at $35 each, total of $350. And then the other layer we would copy across from the purchase, so that would be 75 units, $52 each, total of $3,900. Okay, then on the 21st we have a sale. We sold 70 units, and this is first in, first out. So if we sell the oldest units, we know we have to sell 10 of those that are the oldest. We have 10 of them that we paid $35 each for, total of $350. And then the other 60 are going to have to be some of the ones that we paid $52 each for. So that will be a total of $3,120. And then what we're left with in ending inventory will be 15 units, which will be ones that we paid $52 each for total dollars of $780. And then on the 30th, we made another purchase, 10 units, $55 each, total dollars of $550. And then we'll have 2 layers of inventory. So the first layer we copy down from above, 15 units, $52 each, total is $780. And then the other layer we copy across from the purchases, so 10 units, $55 each, $550. Now for the totals at the bottom, for the purchases, we have to add together everything that is above that, above the totals. So quantity would be a total of 85. Total cost would be $4,450. Cost of goods sold, same thing, we have to add together everything that's above. So quantity, 115. Total cost, $5,045. Now for inventory on hand, make sure you do not add together everything that's above. Inventory on hand, you're only taking the most recent date. So for that, all you have to do is add together the two numbers that are on January 30th. So it would be 25 units, and adding together the $2 amounts, the total cost would be $1,330. Okay, next we do LIFO. I'll fill this in very quickly because a lot of it's the same until we get to the point where we make a sale on the 21st. Okay, on the 21st, we sell 70 units, last in, first out. So all 70 of the units we sell will have to be some of these 75 that we just purchased for $52 each. So $52. And total cost therefore $3,640. And so after that sale on the 21st, what we'll have left is 10 of the old ones at $35 each, total of $3,500, and we'll have just 5 of the new ones left at $52 each, $260, or I have an extra zero here, actually. Okay. $260. I think I have another one here where I put an extra zero in. And the 30th, of the purchase. Okay, then we'll do the weighted average. This will be a little different.
I'm sorry, where you got these numbers?
Which numbers? All of them?
Yes.
From the previous ones. From the,
From a table, okay. No, I just see everyone take the numbers and then where?
If they're the same as I did on the FIFO one, I'm not really repeating myself on explaining them.
So we just repeat the second tablets and next tablets, just repeat from the previous one.
Yeah. The main thing that's different is on the 21st of the month.
what you, yeah, what is a purchase? I mean a sale.
Let me see if that's true. Okay, on the eighth of the month, there is a difference now, because remember with weighted average, whenever you make a purchase, you compute a new weighted average. So, let's see. So on the 8th of the month, we had $350 in inventory, and we purchased $3,900 more. And then we divide that by 10 units that we had in inventory plus 75 units that we just purchased. So that's why our new weighted average cost on the 8th is $50. That's where this $50 comes from. So that's different than it was with LIFO and FIFO, because we make a purchase, we're computing a new average weighted cost. We fill that in here as our unit cost. Then when we make a sale on the 21st, we use that unit cost, the weighted average cost that we just computed for our sale. So on the 21st, we sell 70 units. So we sell them at that weighted average cost of $50 each, total of $3,500. And what we're left with in inventory is 15 units, which will also be at that weighted average cost of $50. Total cost of $750. Then on the 30th, we make another purchase 10 units at $55 each, $550 total. And so, because it's a purchase, we have to again make a computation of the new weighted average cost. So now our inventory was $750, plus we just purchased $550. And we divided that by the 15 units we had in inventory plus the 10 units that we just purchased. So our new weighted average cost is $52. And so now we fill that in here as our unit cost. We have 25 units now in our ending inventory, and multiplying our new weighted average cost times the 25 units gives us a total cost in our ending inventory of $1,300. And then I'll fill in the totals. Okay, then, like before, they wanted, on the previous problem, they want us to compute the cost of goods sold amount. Well, this is easy. Cost of goods sold, we computed up above. For FIFO, it was 5045. For LIFO, it was 5215. For weighted average, it was 5075. Okay, now they want us to compute gross profit. So just like on the previous problem, we have to figure out what the sales revenue was. So here's the data table. Split my screen again. So we sold 45 units at $83 each, and we sold 70 units at $85 each. So that's total sales revenue of $9,685. So that will be the same for each of the three methods, that doesn't vary. And then fill in the cost of goods sold numbers that we just filled in above. And then by subtracting, we get gross profit. So 4,640, 4,470, 4610. So you can see, just like we were saying during the lecture, that gross profit's going to be highest for FIFO, it's going to be lowest for LIFO, you'll be in between for weighted average. Again, this is assuming that our costs are going up over time. If costs were going down over time, the opposite would be true. Okay, then it says, if the business wanted to maximize gross profit, which method would it select? What do you say? Yeah, FIFO. Correct. Okay. That was it.